Good afternoon, everyone, and thank you once again for joining us today. I'm Jim D'Antona, the President and CEO of the San Luis Obispo Chamber of Commerce. We started this weekly free webinar series at the beginning of the shelter in place to provide our community with the most credible and up-to-date information and resources. While we are a membership organization, we have opened these webinars to the public because we know how important connecting you to information and resources is at this time to ensure our regional economy is able to come through this successfully. Today, we will be diving into the latest announcements regarding the reopening guidelines from the state and county. Then we will be bringing in our guests and discuss the latest legislation changes and information available about the SBA loan forgiveness. Our distinguished panelists today, who will be discussing the latest regarding the SBA loan forgiveness, come to us from Glenn Burdette. Glenn Burdette is one of the leading certified public accounting firms on our Central Coast. They've been spending a lot of time analyzing the details and information that are coming out of the government and have been gracious enough to come here and help provide their thoughts to you. Our first panelist has been with us before and has been the point person at Glenn Burdette on all of this analysis. Tim Dossa is a business consulting manager at Glenn Burdette. Tim began his career as an auditor in public accounting, including 2 years at Glenn Burdette, before spending 19 years with a Fortune top 10 company. He is known for his ability to tackle a wide range of issues related to accounting, process improvement, automation, innovation, technology, and change management. Our other guest from Glenn Burdette is Rachel Carscaden. She's a principal at the Glenn Burdette firm. A San Luis Obispo native, Rachel graduated from Cal Poly and then launched her public accounting career in the San Francisco Bay Area before eventually landing a position at Glenn Burdette. Her expertise lies in partnership and corporate income taxation, as well as tax compliance and planning for individuals and closely held businesses. Her specialties include agriculture, real estate, manufacturing, and professional services. I thank you both for being here today. As always, we will allow our panelists to give their presentations and then allow for questions. Please notice the Q&A button at the bottom of your screen. If you have questions for them or me, please enter the questions in there. Do not use the chat for asking questions. If we have links that we will be sharing with you, we will share in that chat. So let's start out with the latest from the state and the county on the latest reopening guidelines. I know we started this with phases, and then we told you there were stages, but I think at this point, there aren't really any hard and fast rules regarding reopening. If we were to give this reopening stage a number, I might use 2.875 because it's mostly stage 2s, but some stage 3s with restrictions. So the best way to track all of this is if you head over to the readyslow.org, the page up here on the screen, and click on the reopening page link. From there, you can scroll down to the businesses allowed to open June 12th with self-certification. There we go, right there. And once you're there, you can find the comprehensive list of businesses that are allowed to reopen following the self-certification process. What I would add is that if you are following in the following industries or have these services, you should note that there are special rules in some of these. For instance, in the second one there, individual outdoor recreation, when you open that button, you essentially find out that no organized sports can move forward as part of this opening. They're talking right there about charter fishing, equine facilities, and archery, obviously individual events. And so please note that. If you go to the public swimming pools page there are a lot of specific notes related to this one. So if you're a hotel or an apartment building, please look closely at these guidelines and note that hot tubs, spa, pool are not allowed to reopen at this time. The next one, gyms and fitness. And this is one, especially as I know how so many of our gyms and fitness businesses will be opening at this time. This has a lot of notes. Specifically, no indoor group classes. Outdoor group classes are allowed, but only if there isn't shared equipment. So it seems like, I think like a Tai Chi would be a great example of what would be in a group class, but outdoors, not indoors. They do talk about shared equipment as being one of those triggers, but from an individual, I believe from an individual perspective, those would be allowed. It's where it's spinning, Zumba, some of those things where they're group classes that people are constantly rotating through, that would be the bigger problem. Additionally, if any of you are doing music, film, and TV production, there's some notes in there that you might want to click on. And if you are, it sounds cool, let me know. I can come out and help you out with it. Our biggest one, though, obviously is going to be the restaurants, wineries, and bars who weren't allowed in stage 2 and are now allowed to roll here. So the only note they have there is that there's a limited opening subject to the stage 2 rules. Essentially, you're going to be looking at distancing, etc. And then the last 2 also have those same limitations to stage 2 schools, but they also have a much bigger issue in working with the California Department of Education. And then zoos and museums, for as many of those there are, with those same stage 2 limitations. So this has always been our #1 resource to find where and what you need to do in order to reopen. The county has confirmed, if you haven't heard, that these items are allowed to move forward with that self-certification. And again, we can't stress enough how important it is for your own protection, for your customers' protection, and for the safety of everyone that's in there, that you follow through that self-certification process. That's all we have on the stage 3, or the stage 2.875, whatever it is. But these are the business now for reopening, coming from June, opening on Friday. So what I'd like to do now is transition over to our panelists to discuss the important information that has come out regarding the forgiveness portions of the SBA loans. Tim and Rachel, thank you both for being here again, and I'll turn it over to you.
Awesome, thanks Jim, and thank you Chamber for having us back again. We're always excited to come back and talk with everybody and be part of the Chamber. Got a presentation to share with you today, and I gotta do this right. Share my screen. Share. Is that working? Rachel, you're on mute, just FYI.
Yes, it is.
Okay.
Yes, it is.
All right, well, thanks again. Before getting into some of the details today, we just want to start off with a caveat. We'll do the best to answer as many questions as we can today. Note that every time new regulations come out and new guidance comes out, there's more questions than answers oftentimes. And when new regulations are passed by Congress, they tend to be written in legalese. And then it gets interpreted by some of the governing bodies like the Treasury or the SBA or the IRS, and then it gets put into action. So with the new forgiveness rules on the Paycheck Protection loans, we're still in a bit of the legalese phase of this and waiting for a little bit more guidance, but we'll do our best to explain what we know. As a primer, the Paycheck Protection Program loan, the basics of it were you got funded based on 2.5 times your monthly average payroll costs. Forgiveness obviously is available, and you had to certify that you needed the loan, although they came back later and said, as long as it was less than 2 million, you didn't need to certify it, and that made things a little easier. The payroll costs and non-payroll costs below, you can see, used to be 75% and 25% were the guidelines, and now it's 60% and 40%, and Rachel will explain that a little bit more later, and what a good flexible tool that is going to be for people. But your payroll costs, your wages and compensation, limited to $100,000 per person, group health insurance, employer paid retirement benefits, and state and local payroll taxes. And then on the non-payroll side, you've got your rent expense, mortgage interest, and then those utilities listed there. So that's just a quick recap. Most people are well versed in that so far. Some of the new rules that came up before this last set actually involve payroll versus non-payroll costs. So with payroll costs, typically you were going to start your covered period, meaning the period where you start measuring the expenses, with your funding date. One of the changes that they proposed and and issued was that for payroll costs, you can have this alternative payroll covered period, which is the first day of the first payroll period following your loan funding. So for example, if you were funded on May 4th and the beginning of your next payroll cycle was May 8th, you can start counting your payroll costs May 8th going forward. If you do that, you still have to use May 4th as the start date for your non-payroll costs. So now you have two different periods to cover. A lot of this may be made a moot point with some of the newer rules, but it's important to understand these two covered periods. With your payroll costs, people used to ask a lot of, is it what we paid? Is it what we incurred? The answer is really both. So you can include what is paid in your covered period, but also what's incurred, provided that it's paid by the next regular payroll date. So for example, if the end of your covered period is June 29th, let's say, and your payroll ends July 1st, you could include all, and it's not paid until after July 1st. You can include all those payroll costs up to June 29th, the end of your covered period, even though it wasn't paid within your covered period. So that's a concept that is not only for payroll costs, but also for non-payroll costs. So your mortgage interest, your rent, your utilities, all of those costs are included in forgiveness, provided that they are paid within your covered period or incurred. So as another example, if you had a utility bill that you pay on the 15th of every month and your covered period ends, again, June 29th, you could take the next bill that you pay in July and basically include half of it in your forgiveness total. So that was some good clarification that we got on that, and I think it's going to make it easier. Provided that you pay it on the next date, the next billing date, you can include both paid and incurred. I know that's a lot, but it's a helpful and it's actually a really important clarification of what you can include in your payroll costs. And then remember, on your mortgage interest and your rent, you had to have had those loans or those leases in place prior to February 15th. So if you signed a new lease after February 15th, it doesn't get included in the loan forgiveness costs. Okay, and with that, we've got some recent changes that just happened about a week ago. I'm going to kick it over to Rachel to cover those.
Thanks, Tim, for starting and providing that good background. So on just last Friday, they passed a new law that changed the details of this program. And what I wanted to cover is how loan forgiveness works and include these changes. And I think by understanding a lot of the details, you'll hopefully qualify for the most loan forgiveness possible. With that being said, keep in mind good business decisions. I think a lot of people are getting hung up on this concept of getting full loan forgiveness. But if you get close and say you have a $100,000 loan and you qualify for all but $10,000, having $10,000 to pay back might be okay, because one, it's a 1% loan, or two, because maybe that cost is a better long-term decision. So always, weigh good business decisions with trying to maximize this program. So some of the easy changes to start include, if you have some of the loan that's not forgiven and it converts into a traditional loan, originally it was a 2-year loan, and it will continue to be a 2-year loan if you got your loan approved before June 5th. If your loan was approved on or after June 5th, it's now a 5-year loan. If you had the loan prior to June 5th, you can ask your bank for the 5-year loan. They may grant it, but are not required to. Regarding the loan, payments of interest and principal do not start on that loan until the SBA approves the loan forgiveness and pays off the lender. So to really think through that process of how it would work is you get funded, then you have this period of time to spend. Once you've spent your money and you've spent the time that you're allowed to spend it on, you then submit an application for forgiveness. You have up to 10 months to submit that application. Once you submit it, the bank has 60 days to process, and then the SBA has 90 days to process. Once the SBA processes the loan forgiveness, approves it, they pay off the bank, and it's from that point forward that you actually start making payments on the loan. Our understanding of how interest will work is that interest will accrue from the start of funding, but only on the true amount that's not forgiven. A few more easy changes and details. The last day that they're allowed to accept and approve these loans is June 30th. So if you have not received a PPP loan, we recommend getting on it now. As we all know, there was limited funding. The funding ran out really quick. They luckily granted more, and there's still forgiveness. There's still loans available. So they'll have until June 30th. Like I mentioned, you have 10 months to apply for the forgiveness once you've completed your covered period. And if you don't end up asking for forgiveness, there's 10 months that lapse before you actually have to start making payments on the full loan. So one little change is they clarified in the law that was passed on Friday that if you get a PPP loan and you chose to previously defer your employer portion of payroll taxes, you can still defer those taxes. The old rules said once you got the PPP loan, that deferral option wasn't an option anymore. So again, when we talk about applying for loans, a lot of our banks locally are not granting any more loans, but we're hearing that the online lenders still are. So explore your Divvies, your Cabbage, PayPal. Those options are still out there. What started to happen is they put out this program and the rules were very strict to start. And then they realized how slow everything was taking to reopen. And they realized that a lot of people were going to end up with a loan at the end of this and not have as much forgiveness as the program really intended. So they originally gave a safe harbor, basically an out, to where if you met this exception, you wouldn't have your loan forgiveness reduced. On Friday, they added more and more exceptions that are basically loosening the program, and we believe will hopefully allow more people to see full forgiveness, but see it more based on the true reality of their business and not try to manipulate things to get the whole full loan forgiveness. So on this slide, we really outline a lot of the ways you can fall back on, hey, I didn't bring my employment up to the same levels as before, and it's not my fault. So to back up for a sec, what this program does is it looked back and they granted you a loan based on the past, and they said, well, based on the future and how you spend that loan, that will determine how much is forgiven. But what they realized is all these holdbacks and reopening, people weren't able to spend the money in the limited amount of time. So here, if you tried all these things and still can't spend all your money and bring your people back, it's okay. So if you can't return to the same level of business activity because of all the restrictions by Health and Human Services, the CDC, or OSHA, if you're unable to rehire former employees or find qualified replacements, if people voluntarily resign or let go for cause, ask for a schedule reduction, those aren't going to count against you. The best thing that came out originally was this out that said, well, if you, by June 30th, ask your employees to come back and they decline, you can, if you document that, it's not going to hurt you as well. What they did recently is extend that date till 12/31/2020. So there's really a few outs, and what we'd suggest is look at the rules as is and then see if you really need to rely on these alternative options. And then I think if you do, really explore them to see what you would qualify for.
Yeah, and Rachel, I think the key here is to document, right? So if you have workers that don't want to return, make sure you get something in writing from them. If you offer people a job and they decline, that's another one. That's another strategic move too. I have one client who said that they had a number of employees just take this opportunity to retire and they weren't going to come back. And I said, ooh, here's what you do. Offer them a job, tell them to help with your loan forgiveness reduction. They'll decline it because they're going to retire, but you won't get your forgiveness reduced because of that. So you want to think through some strategic moves like that.
Yeah, and I love the point to document. We're used to documenting. We're used to building our file of support. That's what you want to do in this case. You want to show, I tried, but, and explain why and show why. And Tim will go into more details on how we measure pre and post levels of employment, because that's really important to this loan forgiveness piece. It's not about just spending the money, it's about maintaining employment. And that's what this program was designed to do, was keep our employment up through the crisis comparable to where it was. So moving on, we're going to cover the better changes to this program. I mentioned it already, where we had only 8 weeks originally to spend. Now they'll give you up to 24. This was just a recent change. So it's one of those things where they say this and they say it in their legal language, and then Tim and I start jumping on the phone. Well, what does this really mean? And all our clients start asking, well, what does this really mean? So we'll probably have more clarification. And the intent of this change was to give you grace to choose. So if you only need 12 weeks, it sounds like that'll be an option. So it's not 8 or 24, but more to come on that. The other great change is something Tim mentioned quickly, is before you had to spend 75% of your loan on payroll items. That's now down to 60%. With that rule, we get into the technical calculation of that, and we're like, well, if you spend less than 60% of your loan forgiveness amount must have been used for payroll. And we're like, what does that really mean? So we provide a simple example. If you have a $100,000 loan and $50,000 was used for payroll, you back into your maximum loan forgiveness by dividing by that 60% percentage. So as you can see from this slide, it really helped by making this change. And the thing to really mention in this, in considering the 60-40 ratio, is in the payroll bucket, in the 60% bucket, gross wages are capped at $100,000 per employee. And it's the percentage of $100,000 that falls within the spending period. Whereas any of those additional payroll costs, the health insurance, the retirement, on top of your gross payroll, don't have that $100,000 cap. So when we hear that, and we know sometimes how big of our clients, how much our clients spend in, say, retirement matching, there can be a strategy here, and then there can be complication here. So I think you can look at it both ways, and if you can simply get there through gross payroll, get there through gross payroll and don't get into the gray. But maybe you need to kind of get into the gray and say, well, can I use my retirement plan matching as a strategy? So I don't want to go much further into that, but I think there's an opportunity there for a lot of companies.
Yeah, and as perspective, for example, if you got your loan funded on May the 4th, your original 8 weeks would have ended June 29th. Now with 24 weeks, that ending date could be as late as October 19th. And it gives you a lot more time, especially if you weren't able to open and weren't able to use those payroll costs right away. I know that some people really struggled with that initially, to say, what do I do? Do I pay people to stay home? Do I have more? And so for the folks that maybe weren't as aggressive on it, now it gives them a chance to maybe bring some people back now that things are opening up and use those funds and get that full forgiveness. And if you go out and get a loan today, then the 24 weeks would end on November 26th. So you can see how it really stretches out that timeline.
And one way I think of it is, if you can only open up at 50%, in a simple world, you only have 50% employment. So if you have double the time to spend it, you'll be more likely to spend without paying people extra to do nothing. As we mentioned, as they make these changes, there's a ton more questions that pop up. You know, when we think about 8 versus 24, is it only 8 or only 24? Can I have something in between? A big concept that Tim and I have been talking through is, okay, well, if I choose to spend over 24 weeks, does that mean I have to hang on to my employees through the 24-week period and then through year end? We know the program was designed to have you hang on to your employees as much as possible, but then you get into really the practical situation. So, and then of course, everyone's like, well, now that we have 24 weeks, can I get more funding? We haven't heard of more funding. We know there's funding available for new loans. We haven't heard of another round of funding, and right now you can't go back and ask for more if you already got your loan. It was a fixed amount, it was the max. We mention it quickly here at the bottom, but realize as we were talking about all this information, we're talking about it mostly from an employee perspective. Like you're looking back, you're a business entity that files a separate tax return. You have employees on payroll, you're a partnership, you're an S Corp, you're a C Corp. Realize the rules are different for self-employed individuals. The calculation was different and how you spend is different. So realize that if you're self-employed and did get a PPP loan, which you were allowed to, you have a little bit of different rules. And you know, another question comes up because the rules were specific for the Schedule C and said, hey, we'll give you the full loan based on your 2019 Schedule C net income, but then since that number's fixed, we're gonna say your forgiveness is based on those numbers. And they were based on only 852, 8 out of 52, that percentage of your net income. Now that we have 24 weeks, does that mean, you know, they get more loan forgiveness? So I don't want to go into too many details there, but realize if you look into the rules, there's specific rules for self-employed individuals, and then there's specific lines on the forms that apply to self-employed individuals.
Yeah, there's not been any more specific guidance on the self-employed side with the new regulations that were passed on Friday. So that one to me is still an open question. Whether it's, do I get 850 seconds of my Schedule C income or do I get a little bit more? But realize you're still limited by the maximum amount of your loan, and it's also limited by the $100,000 annualized as well. So you'll never go over those numbers regardless, even if it's 24 weeks.
Yeah.
Okay, so one of the important things that gets overlooked in a lot of the webinars and other folks I've talked to that are deep into this is the calculation of full-time equivalent employees, and it's really one of the more important concepts to understand. When you get the loan and you have a look back period of when you have to measure how many employees you had. So in most people's cases, it was January 1st of 2020 to February 29th of 2020, although there are some alternate look back periods as are listed on the slides. So you have to look at that and figure out how many FTEs did I have then, and then when you get to the end of your spending period, you have to do the same calculation, which is basically here in front of you, the average number of paid hours per week divided by 40. And when you look at the average number of paid hours per week, you think, well, what is that? So if you had employees that worked over the 24 weeks, let's just say, all you got to do is add up all the hours that they worked from your payroll reports and divide it by 24. That's your average number of paid hours per week. You then take that number and divide it by 40, and you get a percentage. You get either a 1 or you get less than a 1. So as an example, they give you two ways to do it. You can do it sort of the actual way, which is the top example. So you've got an employee that averages 50 hours, they're 1 FTE. You can't have more than 1 FTE. Another one that averages 40 hours, they're 1 FTE. And I've got another part-time employee who averaged 10 hours, they're a quarter of an FTE. So that in total says I've got 2 1/4 FTE. They offer a simplified method of calculating this, which basically says you're either 1 FTE or you're a half an FTE. And if you work 40 hours a week, you're 1, and if you work anything less, you're half. So you can use either method, and it's kind of important to do so, because in this example, in your look back period, instead of having, if you use the simplified method, you have 2.5. If you use the regular method, you have 2.25. And you want to make sure that you are, by the time that you're done spending, that you are at least to the number you were back in the look back period. And that's a really important concept. Now, if you get back to the number that you had in the look back period, so if by June 30th, or if it's December 31st, or potentially by the end of your 24-week period, if you're back to that same number of FTEs that you had, then you don't have to worry about having any loan forgiveness reduction related to FTE. And that's a really important thing to strategize about. You don't want it to get to the end of your spend period and then suddenly realize, well, I didn't hire back enough people. There's lots of ways to strategize around this. You can bring people back, early, you can bring them back later, but you want to make sure that you can get there. Otherwise, you're going to have some loan forgiveness reduction. There's another clause about reduction, about if you actually reduce employees' wages more than 25%, that there will be loan forgiveness reduction related to that as well. But if you get their wages back to where they were at in the look back period, then all the reduction is eliminated. This one, I have not seen as much with the folks that I've been talking to. I don't know that anybody, too many people have reduced people's wages. They may have reduced hours and they may have reduced FTEs. But I haven't seen as much of the wages being reduced just yet. And it's not the total amount you're paying somebody. It's really based on their rate that this calculation gets into. And then really lastly, one of the called the bait and switch grant. So when the EIDL loan came out, the economic injury disaster loan came out, it had this grant feature. First it was $10,000 and then it was $1,000 per employee they changed it to, but it was supposed to be a grant and you never had to pay it back, which is true if you only took out the IDL. For folks that took out the EIDL grant and got a paycheck protection loan, it's not the case. So when you figure out your loan forgiveness on the Paycheck Protection Program, one of the last steps you're going to do is put in what was the amount of the grant that you got from the EIDL. And that gets subtracted from your loan forgiveness and essentially becomes part of the PPP loan that you're going to have to pay back. This was a real bummer in my mind. That's why I got the thumbs down. It was not as clear when this program first came out, but when the forgiveness calculations and the rules came out, it was pretty clear that this was the case. So keep that in mind if you have an EIDL.
So we have been getting a lot of questions. So we've heard the common questions. So we wanted to cover a few before we open it up. So of course, as they come out with all this information, us on the tax side are like, well, how does this work for income taxes? And we start thinking it through. So the way this works in the accounting world is it's really a loan to start, and I would see it residing on your balance sheet as a loan until you prove to the bank and the SBA you spent it and therefore it's forgiven. So at the time it moves off your balance sheet and it runs through your P&L as income, and luckily it's not taxable income in this case. However, the way the tax code is written right now, when you pay for things with tax-free grants like this, they're non-deductible. So if you think about it from the separate business side, you have cash coming in, that's income but not taxable, and you have cash going out, that's not deductible. At the business level, you net to zero. What you did with this money is you paid it out to your employees, it's income to them as compensation, or you paid it to your landlord and it's income to them as rental income. So for the business, it's a wash. For the recipient, ultimately, it's income. What, like the AICPA, the organization that us CPAs are a part of, we're asking for clarity of this because we don't believe that was the intent of the law. And we're hoping that they would give us a deduction and get the business a tax benefit from this. Of course, California wants to do things their own way and says, no, the loan forgiveness is actually income, it's taxable, but therefore the expenses are deductible. So we're gonna have right now a whole set of separate accounting to do for California to get to the same spot. So we're gonna show it as income and we're gonna show it as a deduction and get to the net zero at the entity level. So two different methods. Another reminder, kind of like we said, you really need to prove this to the bank and you really need to track it well in your books so that CPAs can see this. So it's going to add to complication to your 2020 tax return. A big question we keep getting is, can you give raises and bonuses during the covered period? We say yes, as long as they're reasonable and they're following those concepts that Tim said, paid or incurred. You know, and a lot of times we justify that. We're saying, hey, you brought back this employee, one employee to do two people's job. It might make sense to give them a raise. You may be having them work under hazardous conditions. It probably makes sense to give them a raise. So we don't see any issue with that. Just keep in mind that $100,000 cap on payroll per employee. Can we prepay rent for the rest of the year? No, you can do what Tim said earlier, but you can't go and prepay all your rent. And then lastly, what kind of documentation should you keep? Things like payroll records, health insurance payment records, retirement contribution docs. Put your auditor hat on and say, how can I prove this, that I spent it as you told me I had to? So utility statements, mortgage statements, bank statement, lease agreements. Make sure you have all that stuff. Remember, you're going to be pulling that together, providing it to your bank. So the bank, it's got to get through the bank to okay the loan forgiveness, and then they have to get it through the SBA. They have to approve the loan forgiveness. So how can you make it easy to get through all the stages with no problems? Lastly, we have a few tools. So as Tim kind of mentioned, you know, the law is written and then the SBA provides guidance. So there's a lot of FAQs on their website. Same with the US Treasury, a lot of FAQs. So here they're going to talk about these details that we're like, well, what about this? What about that? These are good resources. The SBA finally came out with a loan forgiveness application. Realize that came out prior to the changes on Friday. So we finally got an application, but it's going to need to be revamped for the changes. And what we found is, of course, we want to, I would suggest reviewing that and making sure everything works through there as we expected it to, because that's what you're ultimately have to provide to them. But if you need to play with the numbers, that tool's not as helpful. So the AICPA came out with a loan forgiveness Excel tool. So we found like that mirrors the loan forgiveness application, but is easier to play with if you're running into this situation where, do I have the right amount of employment on the COVID period versus the pre-COVID period? So a tool like that can be really useful if you need to kind of run the numbers or see it all the way through. We threw it in here, it probably is not important, but again, in addition to the tax treatment, then you start wondering, well, how do you really record this for accounting and GAAP? So there's going to be tools like, or materials like this and guidance also issued for that. From this point, we were going to open it up to questions, which I think Jim's going to moderate.
Yep, get my video restarted here. And it somehow, yep, okay, got it. Sorry about that. Didn't want to interrupt your fabulous presentation there. So a couple questions that just from me that kind of without using the audience yet. So one of the things you talked about there was the EIDL grant. Is that just the $10,000 portion they put in your account that you're talking about that then transfers the loan, not the whole EIDL loan, right?
That's correct. Yeah, just the grant portion is going to get subtracted from your loan forgiveness. So you could do everything perfectly on your Paycheck Protection loan and get 100% forgiveness on that. But if you've got an EIDL grant, the grant portion is going to turn into a Paycheck Protection loan at the end of it all.
Okay. Yeah, that's what I thought I heard and understanding, but I know, well, actually there is a question in there that asked that exact, because they weren't sure, like, wait a minute, what did I get? So the other interesting one that it was a good math equation you put up, and maybe we can go back to it at some point here, or maybe you can do it verbally, is that if less than 60% was used on payroll, and then 60% is for the, how did we get to 83,000 on the, because I'm pretty good at math, and I was like, I can't do it. So is all of that is expenses used for non-payroll also forgivable if used in the right percentages? Or is that how that calculation's happening? Or how are you getting to your number? At least, don't expect you to go break down every piece of it, but in looking at this, if you could just give a quick summary of that, that'd be awesome.
Yeah, I think the way to think of it is 83,000 of the 100,000 is going to be forgiven. And then of that 83,000, you spent 50 on the payroll bucket, and then the remaining on the other items, the rent, the utilities, and the mortgage. So of the 83, it's 50,000.
When the new rule first came out, it was written in such a way that basically said, if you don't spend at least 60% of your loan amount on payroll, you get no forgiveness. It's quickly squashed, and the villagers were calling on that one, because that was not the way the 75% was supposed to work. It was simply saying, no matter what you spend on payroll, if it's less than 60% of the loan, you basically just have to divide it by 60% to see what your maximum forgiveness is going to be.
Okay, so the maximum forgivable on that would be 83,000, not 100,000.
Yeah.
In that scenario, you're not earning 83,000 of technically in that space, right? You're saying your max forgiveness is 83,333.
Correct.
Okay. Then you have to pay back the rest. You can pay it back at the end if you didn't spend it, or you can pay it back over 2 or 5 years. And so I think a lot of people might want to spread it over 5 years, especially at a 1% interest rate, and it's not a big deal. But I think it's good to work through those calculations and just know what you're working with.
Yeah, definitely lower than the freest money you'll ever get at 1%. That's
right.
Yeah.
That's right.
And keep in mind, you mentioned the EIDL loans. Those are at 3.75 versus this at 1%.
Yeah, definitely.
But the EIDL is at a 30-year term. So that's another good loan.
Yeah. All of it really, I mean, affordable and definitely better than your commercial loans that you're getting out of banks. So one of the questions that came in, I think you addressed most of it. Obviously, the 850 seconds of a self-employed, that one really seems like they didn't address, you said, any new rules to that. So all the previous rules apply?
Yeah. For self-employed, it was really interesting. They basically said, give us your Schedule C, and if you made over $100,000 of net income on your Schedule C, then you need to take that number down to 100,000, divide that by 12 months, and then multiply it by 2.5. That's the loan that you could get if you were self-employed. And then they said, well, on the forgiveness side, you don't have payroll, so how do we figure out what you get forgiven related to quote unquote payroll? And so the rule is you get it's a fixed calculation. You get 850 seconds of your 2019 Schedule C net income, limited to 100,000, as your forgiveness. And so whether or not you even took that out of your business or not, that's your forgiveness amount. So the question that we had was, well, that was based on an 8-week period. That's where the 8 and the 850 seconds came from. So now that it's 24, the math is a little funky. We don't really know. And so they didn't provide any extra calculations or any guidance on that. They just silent on it.
Yeah, and I think that was one of the questions that came up in our group here, that the 8 to 24 is really how much time you have to get to the spend, right? Not, as you said, Rachel, the idea that it's somehow now I can get 24 weeks of loan part of it. It's not additional monies, it's definitely related to how long you have to spend to get to those FTEs and dollar amounts, correct?
Right. They didn't change how the maximum loan was calculated, only how the forgiveness works.
Right. Okay.
But I think a lot of people got their hopes up, like, oh, will they do more?
Yeah, I remember telling someone that on a phone call the other day, and they went, I'm like, no, just how long you have to. One question in here that, do telephone expenses from cellular phones that you pay for your employees paid by the company, would that count as, is that a non-payroll expense that it's allowed to be counted, or is that potentially, as it's being compensated to the employee, counted as a payroll expense, or keep your records and dance?
If it's a utility cost, it's a utility cost, but if you're compensating it on employee gross payroll, it's part of their payroll.
Yeah, if it shows up in the gross wages in the payroll report, you're going to capture it there. So you wouldn't want to double capture it as a utility as well.
Got it. You did touch on it, and I think it fell in the gray area. We did have someone, before you got into it, talk about pension contributions as potential payroll, or how that fit. But as you, I think you maybe say that again in terms of go for the black and white part you got clear before you start wandering into the gray.
Yeah. So realize you have gross payroll that falls into that 60% bucket, and then you have these other things that can be added to help you get to the 60%. Traditionally, people pay retirement contributions. What we're talking about is, how much is the company covering in like a match? How much is the company putting into the retirement plan for the employee? And everyone does it a little different. Some people fund throughout the year. Some people wait to fund and fund after the year end because you're allowed to. Some people have fiscal year ends and fund at unusual times throughout the year and actually need that deduction. So it gets overcomplicated when you start saying, well, how much of that is allowed? Is it simply the 24-week average of the year, or because of your timing can you fund more? So there's opportunity in that complication. And so that's where I'm saying, if you get there easily with gross payroll, maybe you don't need to go into there, but if you need to go in there, there can be a strategy.
Excellent, thank you. This is an interesting question. If your loan was awarded before June 5th, do you need to ask your bank to extend for 6 months the loan forgiveness, or is that an option?
There's no more 6-month period.
Oh, okay, so if you were before, that's not as.
It's the max term of the loan that is different between a pre-June 5th and a post-June 5th loan term. So if you walked in after June 5th and got your loan approved, then if you have anything left over after forgiveness, you have a 5-year term to pay it back. If you got your loan before June 5th, if you have anything left over at the end, it's a 2-year loan term to pay it back, unless you can get your bank to agree to this new 5-year rule. And like Rachel said, they're not required to, but they can.
Yeah.
And then furthermore, I think what people are hung up on is, you got the loan, when do I have to start paying it back? Like, how much a deferral period do I have to start making payments? And if you think about the deferral period currently, you have your period, it's up to 24 weeks. Then you have 10 months to apply, and then you have those 60 days for the bank to process, and you have 90 days for the SBA process before you have to start making payments. So it could vary depending on when you apply and how quick they process.
Awesome. Yeah, great. And we have a question here, but I think you did talk about it. They were asking about, do you have to have the same number of employees, bringing on new people, for instance, to replace? It's not a Social Security like they're not going to look at the Social Security number and go, you didn't hire back the same. Were your full-time equivalents and your dollar amounts where they should have been for what you were given on the loan? Is that correct?
Yeah, and I think that's important in a town like San Luis, where you let go a lot of college students. You're like, these college students are gone. I can't bring that same person back. Maybe that person doesn't even want to come back, but you have to attempt to hire someone to replace them. It doesn't have to be the same person.
Awesome. This one has transportation costs are covered. I don't know if that's employee transportation costs, or is that moving equipment or stuff like that? But it just had transportation costs.
That's a good question, and that's one that we have contemplated as well. It's a bit open-ended. We think it really relates more to if you have transportation costs of getting goods from here to there, shipping, freight, but it can also be it can also be just transportation costs for doing the normal course of business, right? If you have to, and then Rachel, maybe you've got more insight on this one, but people have asked, well, if I have to pay my employees to drive from here to there to do something for business, are there gas costs included in that, right?
As a utility?
As a utility, exactly.
I haven't explored that.
Yeah, they've not provided any definition of that. And in some people in certain industries, like I have a client who's in the trucking industry, and they're like, oh, that's great. I got lots of transportation costs because I do trucking. So I would hope to see some more guidance on that, but I think really it comes down to this sort of question of reasonableness. If it's a reasonable cost that is normally included as a utility, yes. If it's something that is not, I would probably say no.
Yeah.
Excellent. Yeah, it's and again, I know how often these things are changing. So all of this today is what is happening, and maybe somebody has. If you spend 76% on payroll, does that limit the max you can get at all? The max limit, or I would assume forgiveness that you can get but you'd be over the amount, so there wouldn't be any reduction unless you run into the other problems, right, of full-time employees or something like that.
That's correct, yeah. You could spend it all on payroll.
Yeah.
How long do I have to maintain the FTEs once I get back to the amount I had during a look-back period? Just making sure you cover the loan area, and then up to you.
Yeah, that has probably been the biggest question that we have been trying to get answers to. So I think Rachel touched on it somewhat. You've got the 8-week period, you've got the 24-week period. And so what if I use up all my funds in, say, 12 weeks instead, right? I'm falling sort of in between. Can I then use my 12-week period not only as, okay, here's when I'm cutting off my spend, because I've spent 100% of my funds, but it's also the period I'm going to use for FTE measurement, right? I'm going to compare the 12-week FTE number versus my look-back number. The answers we've gotten so far are yes, you can use the 12-week period if that's where you're cutting it off. You don't have to wait until 24 weeks, and you don't have to wait until December 31st in order to do that measurement. You can, but you're not required to. That's the feedback that we're getting so far. I've yet to see it, printed and in actual guidance yet. But it makes sense as well. If I'm able to get through my loan by, October 31st, why should I be required to hold on to my employees to December 31st to meet that calculation? I might already have my forgiveness calculation submitted and waiting for a response by them.
And I think the way to maybe think of it is you have a couple different hurdles to get over. So you have to spend the money, you have to spend it in the right ratio, and then you got to look at employment levels. So you can maybe spend it all, but then be penalized because you didn't meet the employment levels. You didn't bring your employment up enough. So if you did, then you don't need to rely on that exception. If you didn't, then you might need to rely on that exception where you look forward and say, well, I didn't get there yet, but did I get there by year end? Or at least did I try? That's one way I kind of think of it.
Excellent. So I have someone here who appreciates the great, clear info, and they received a PPP loan grant. But if they're wondering if they cannot open prior to the end of the 24 weeks, we will still need to get back to the full FTE count of the look-back period, ? Or can they just turn that money back in and be like, all right, we're out without any penalties?
It's a good question. The answer would be if you're not able to open by the end of the 24-week period, you're in a bit of a bad spot, right? The 24-week period was intended to allow people to open up and be able to use that money on payroll. If you still can't open up by the end of the 24 weeks, yes, you still need to get back to the full FTE count from the look-back period. Otherwise, you're going to have the reduction. So, the only way that folks in that situation can get some forgiveness is to pay people for not working, which is always ideal, but I mean, again, that was the intent of the loan, is keep payroll going. Or the people that are working, right, you find a way to pay them a bit more or bonus them out, and they're working in hazardous situations or things like that. So you can get your payroll costs up for more forgiveness. That's a tough spot to be in.
Yeah, and maybe it's you spend enough and then you rely on one of those safe harbors to not have reduction, where you say the rules right now limit, I can't open. So
that's a great point, Rachel. That in the presentation we talked about the ultimate get out of jail free card is to be able to say, I cannot get back to the same levels of business activity as I did pre-February 15th of 2020. If you can prove that, you don't have any FTE reduction, and therefore you don't have any forgiveness reduction related to FTEs. The question that we have on that is, well, how do I prove that? What do I have to show you? A P&L to show you sales volumes? Do I have to show you how many people came in the door? That part, I would say, we don't have an answer for right now.
And this one, they put in there, it's an event center, it's the Performing Arts Center. So obviously they may not be open during that time. So certainly could imagine might be an issue. Once again, I think we had somebody ask about the Excel sheet to calculate forgiveness as part of the AICPA, correct? Is that what that was at?
So what we noticed is the AICPA came out with this great tool, and it was live on their website, but then when they passed the changes, I looked last night and the tool's gone. So I'm hoping it's under control. And so we can send it to you guys after if you want to then send it out to your members. But if that tool comes back, we'll keep you posted, because it feels like a good tool to play with these complications we're talking through.
Yeah, especially.
We're hoping nobody would ask that.
Yeah, somebody said, hey, wait a minute, where is it? And so, yeah, especially with the amount of knobs you're turning to try and get to the right, like it's not just one thing to hit, like I got to hit that number. Definitely seems a little harder to do. Go ahead.
I would say it seems simple. If you have similar employment in the spending period than you had in the look back period, you're usually fine and it's not going to be overcomplicated. But if you are running into problems, that's where the tool is going to be really helpful. And say, like, what are my options? Who do I need to bring back? How much? Is it worth it? That's what.
Right. So if you're using, we'll close out on this question. I've been so appreciative for all your time. Calculating the FTEs at the end of term, do you have to use the average FTE for the whole 8 weeks or 12 weeks if you are using the 12/31 time period or the 24 weeks there? If you're using the 12/31 date, if you're spreading obviously that dollar amount over that amount of time to employees, that's probably naturally going to lower your FTEs, correct?
Well, I would say this. The regulations say that you need to look at the period you can either use a 24-week period or 12/31/20, whichever is earlier. So the only way you're going to get to 12/31 is really to get a loan that's approved like right at the end of June. It's really a timing thing. They just put that out there as an outer limit. The FTE calculation, the way it's written right now, does say you're supposed to compare against who you have there at 12/31. We just think that there's going to be clarification that comes out that says, if you finish your spend period earlier, you don't have to wait till 12/31 to figure out, or hold on to those people just to meet that calculation. But theoretically, if you were going to go out to 12/31, you're still going to add up all their hours that they worked from the beginning to that date, and then you're going to divide it by the number of weeks in that period. So mathematically, you're probably going to come out to roughly the same if everything else is constant.
Terrific. Well, look, thank you so much. I want to thank everybody who joined us, and you two especially. A special thank you to our experts, Tim and Rachel, for taking time out of their very busy schedules to join us today. We hope this important conversation helps shed some light on how to think about the loan forgiveness portions of your loan and how to reopen come tomorrow. A recording of this webinar will be available immediately on our Facebook page and our website and other social media channels soon. Additionally, we'll send a recap email to registrants with the Q&A text. There were a couple that we didn't get to. Try to get those answered. And then a copy of the recording. So we'll see you next week on Thursday at 2 p.m. for our weekly webinar. Stay healthy and well. Thank you both.